many ICT traders are focusing on the wrong things, which are causing them to lose a lot more and just get unfortunate results in general, right? Which we don't want, any of us. So in this video, I will do my best at explaining the one and only concept that if there was a holy grail in trading, this would be it. So that is exactly what I'm going to be teaching you in this video. The power of three, right? The power of three is, in my opinion, the most overlooked concept of them all. ICT used this concept for a very, very, very long time. You can go back 7 years on his YouTube channel and find videos of him explaining it and telling people how much he actually studied it. And he did so because he learned by his mentor, Larry Williams, which is also the guy that holds the record in the Robinson's Cup using the power of three. So I do believe that this is the holy grail, if there was one. And I would suggest a lot of people focus on this instead of a lot of other stuff, because once you understand this, and it is not very hard to understand, but once you understand it and have rules for it, this can really, really help you with your trading and increase your win rate. So let's go over it. I am quickly going to run over what it is so everyone's on the same page. I do have a video on it going more in depth with the actual concept. In this video, I am mostly just going to show you how to use it and how I use it. So let's get into it. Okay, so the power of three, funny enough, consists of 3 phases. In the first phase is a consolidation, where price engineers buy side liquidity and sell side liquidity. The second phase of the power of three is the manipulation phase. And the reason that we call this a manipulation phase is because smart money manipulates price to look like it's going to go in a certain way and trick retail traders into longing because they see a break of these high, expecting higher prices. But it is actually just manipulation, and the real move is to the downside in this case, right? So we had our first phase, which was the consolidation. Now we have our second phase, which is the manipulation that takes out either buy side or sell side liquidity. And then we have the third phase, which is called the distribution phase, okay? That happens after the manipulation phase. So in this case, we swept the buy side liquidity, which was engineered in the first phase, the manipulation phase. So we took that out as manipulation, and then we have our distribution, which is the real move that goes to the sell side liquidity, which was engineered in the first phase, the accumulation, right? So you could look at it as the manipulation being the fake move, and the distribution being the real move, okay? So 3 phases. The first phase is where smart money engineers buy side and sell side liquidity. The manipulation phase is where smart money takes out either buy side or sell side liquidity, tricking traders into going long. And then the real move, which is the third phase called distribution, targets the opposing liquidity of the accumulation, right? And oftentimes goes even lower than that or higher. So that is basically what the ICT power of three is. Now you can use this in a lot of ways. You could use it to find your daily drawn liquidity, which I am going to explain how I personally do it, or you could trade it on the lower time frames, which I'm also going to go over in this video. So let's get into it. Here we are on gold, and this is on the hourly time frame, because right now I'm going to show you how you can use this for your drawn liquidity. So a lot of people seem to think that you need to find your drawn liquidity on the weekly and the daily, and that is completely fine. However, I would personally say that the daily and weekly time frame is for longer term drawn liquidities, because a lot of stuff can happen within a daily candle, even though you know that the next day may be a bullish daily candle. A lot of pullbacks and shorter term drawn liquidities can happen within that daily candle. So that is when you go to lower time frames to find a shorter term drawn liquidity, which may not align with your overall drawn liquidity. But that is a tip that I would give you guys, is find your drawn liquidities on the lower time frames, if you are trading the lower time frames, of course. So yeah, this is on the hourly time frame. Here we are going to establish a shorter term bias. And as we can see, we are in the first phase of the 3, which again is called the accumulation phase, where price engineered buy side liquidity, right? And sell side liquidity. So it trades in a range and it has both buy side and sell side liquidity. And now all you do is wait for a sweep of either the high or the low, which we get here, right? The accumulation was swept, buy side was swept. Now, because we know that this is probably a power of three, we are expecting lower prices, and therefore we can have a near drawn liquidity, which is shorter term, and that will be the end of the accumulation, right? So if you are confused, maybe on the daily time frame, you're not able to identify a proper drawn liquidity, scale down and look at the lower time frames to establish a shorter term drawn liquidity. So in this case, my drawn liquidity after the buy side of the accumulation was swept is now going to be lower, right? It is going to be the end of the accumulation, which is this low here. Let's see what happened, right? Very fast, we hit the low because this was a manipulation move, tricking traders into going long, when in reality, price just rallied down, right? And of course, you're not just going to turtle soup this. You're not just going to instantly press sell when we sweep buy side or sell side. Some people do that. I personally don't. In this case, I would wait for us to sweep this, and then I would go on the lower time frames to again confirm that, okay, this was in fact a manipulation move. I can now start looking for shorts, right? So that is how you can use this as your drawn liquidity. This can be done on all time frames, the daily, the weekly, the 4 hour, the 1 hour. In this case, this was the 1 hour. So, but yeah, you can use it on the daily too, and actually trade it on the lower time frames, which we are going to look at right now. All right. This is on the Euro USD. A lot of people comment on my videos asking if the concept works on Forex too. So I am going to start giving examples of Forex pairs to showcase that yes, it does in fact work on Forex too. ICT himself traded a lot of Forex. So yes, of course it works. Anyway, here we have the first phase again, the accumulation phase, right? The first phase where we engineer buy side and sell side liquidity, right? Now, all you do is wait for either buy side to get taken out or sell side. Let's see what happens. In this case, we sweep the sell side of the accumulation. Now we can expect higher prices, right? And what I do in scenarios like this on a lower time frame, right? In this case, we are on the 2-minute time frame. Because this is a very short scalp, it is not very far away. I trade the first PD array that I see, right? So in this case, that would be this fair value gap here. And we did not sweep the high yet, so I'm still fine with taking this gap. And my stop would probably be at the low of the gap, targeting the end of the accumulation here. See if we can get filled. We do. And straight to TP, right? All because I saw consolidation that had buy side and sell side liquidity. Then I waited for a sweep of either the buy side or the sell side of the accumulation. In this case, that was the sell side. I see displacement to the upside, indicating that this was manipulation. And then I trade the first PD array that I see, and I target the end of the accumulation. This can be done on the fifth. I even do it on the 30-second time frame, the 15-second time frame, and the 1-minute time frame, right? That's where I primarily trade, especially during December. But I also use it on the daily, the weekly, the hourly, the 4-hourly, right? I use it in all of my analysis, basically. And that is the reason I wanted to do this quick video. Or I'm actually not sure if it's a quick video, but it is so important to understand and implement in your trading because it can just increase your win rate so much. Especially if you find setups on, let's say, the 15-minute time frame. Once you have identified that it was a manipulation move, which you do so by looking at the displacement after, right? After we sweep the either buy side or sell side, you want to see displacement in the opposite direction. You don't want to see price displaced below the low or high of the accumulation too much, right? It can have a candle closure or two below it and then still act as manipulation. But generally, you want to see displacement in the opposite direction fairly fast to identify that this was in fact a manipulation move. Another thing that you can look for is violations of PD arrays. So in this case, the reason I knew this was a manipulation move is because we have huge displacement that violates, right, bearish gaps. Okay, so because we are violating bearish gaps and obviously holding bullish ones, This indicates that, okay, this was manipulation. We are probably headed for the end of the accumulation and possibly even higher. But what I was saying was, you can go on the 15-minute time frame and you can find the accumulation, wait for the manipulation, and then find your own trading model inside the distribution move, right? The third phase. So let's say you don't want to do this where you just trade the first PD array you see. Let's say that your trading model says that you have to wait for a market structure shift. And then you trade the second or first or whatever your rules are, fair value gap or order block or whatever it is. You can find all of that in the distribution phase. It only just makes the trade higher probability because you have a very, very clear idea of where price is heading next, which is the opposite side of the accumulation. So that was it for this video. Again, I decided to record this video because, in my personal opinion, I believe that this is one of the most important concepts that ICT has ever taught. And I see so many people just not using it. And it's so weird to me because you can literally apply whatever setup you are trading to this model. So you can use it as a confluence and not an entry model. And it just skyrockets your win rate. Like, it makes your trade higher probability. So I see no reason not to implement this in your trading. And that is why I decided to record a video on it. And the information that I fed you in this video is all the information that I believe you need to know about this concept. The reason I created my YouTube channel in the beginning is exactly because of stuff like this. I see so many people overcomplicating stuff, feeding your brain with useless information that is just going to make it harder and worse for you. So that is essentially why I am making videos on YouTube. So I hope you enjoyed, and I hope the video helped you out. If it did and you are not yet subscribed, please do. It helps motivate me to keep recording these videos, even though I really enjoy it. I enjoy the feedback that I get from people, and I'm not trying to sell you anything. I'm not trying to do anything. I'm simply here to just share what I know in a simpler way. So yeah, I hope you enjoyed, and I will see you in my next video. Bye-bye.